Hi friends, I am Anish and in this video we will be discussing about GST implication on supplies made without consideration. Essentially, GST is applicable on all forms of supply made for a consideration. But there might be certain transactions that do not entail any consideration. So, in order to bring those transactions within the tax net, Section 71C of CGST Act provides for inclusion of those transactions that do not entail a consideration within the meaning of supply. Section 71C refers to Schedule 1 of CGST Act, and Schedule 1 to CGST Act enumerates those items which do not entail a consideration but will qualify as supply so that tax can be paid by the transferor. Let us look into those items one by one. Number one is permanent disposal of business assets on which ITC was availed at the time of procurement. Due to certain court order or to comply with any provision of law or any decree, a business entity might be required to transfer its business entities to another business entity without any consideration. So, those transactions will qualify as a supply so that ITC, the benefit of ITC cannot be availed by the transferor. Point number 2, supply of goods between related or distinct persons made without a consideration. Now, what are related persons? Related persons have been specified in CGST Act for this purpose. So, if any supply is made by a business entity to these specified related persons without any consideration, it would fall within the purview of Section 71C, and accordingly GST will be attracted. Now, what are distinct persons? Relevant provisions of CGST Act defines distinct person so as to include a person who has obtained separate registrations in different states. In other words, if a person has obtained separate registrations in two different states, then both these registered units will be treated as distinct persons in the eye of GST law. Let's understand this by way of an example. Company A is having its head office in Mumbai and has its factory located in Delhi. So, any transfer of goods or services between Mumbai head office and Delhi factory without a consideration would fall within the tax net of Section 71C, and accordingly GST will be made applicable. The entire idea behind this is to ensure seamless credit mechanism. This entry in Schedule 1 aims to bring into TaxNet interstate branch transfers and not intrastate branch transfers, because in case of intrastate branch transfers, the company would not be having separate registrations. In case of intrastate branch transfer, the company would be having only one registration. So it does not fall within the purview of section 71C. Only branch transfers between interstate branch transfers are covered in this section. Point number 3, gifts made by employer to employee. Where an employer gifts any object to his employee, then such kind of gifts will fall within the purview of section 71C, and accordingly GST will be paid. But there is a threshold limit of rupees 50,000. Above the value, if the value of the gift is above 50,000 rupees, then only this section will be attracted, and if the value of the gift is below rupees 50,000, this section will not be attracted. However, one thing needs to be understood in this respect. A clear distinction must be made between gift and perquisites. What are gifts? Gifts is something which an employee cannot demand from his employer as a right. Gifts are something for which the employee cannot move a court of law to obtain it from his employer. Whereas perquisites are benefits that flow from the employer to the employee in relation to his employment, which means that perquisites are those benefits which are part and parcel of the CTC, cost to the company. Perquisites flow from employer to the employee by virtue of the provisions of the contractual agreement made between the employer and employee. So perquisites do not fall under the section 71C. Only gifts fall under the section 71C. One more thing needs to be understood over here. For example, if a company, as its company policy, as a part of its HR policy, offers the benefit of free club membership to all its employees, then this free club membership given to all the employees, this do not constitute a supply without consideration. Why? Because ITC on club memberships have been specifically excluded. A company cannot avail the benefit of IDC paid on club memberships. So, where the company is not availing IDC, question of charging GST do not arise. Point number 4. supply of goods between principal and agent. There might be a situation where the principal supplies goods to his agent on the condition that the agent will supply such goods to the customers on behalf of the principal. Second scenario, there might be a situation where the agent procures goods from vendors on behalf of the principal and supply all such materials to his principal. So, in such cases where the supplies are made between the principal and his agent without any consideration, it would be treated as a supply without consideration, and accordingly GST would be attracted. Basically, there are two separate supplies being taken place. One, when the agent procures the materials from the vendors, one transaction, and the other transaction takes place when the agent supplies those materials to the principal. The entire idea of treating the two transactions separately is to ensure seamless credit flow, and it also fulfills the prime objective of GST, that is destination based taxation system. A classic example of such transaction is sale of telecom recharge coupons. Telecom companies sell telecom recharge coupons to the agents, and the agents sell these coupons to final customers. So on both the legs, GST is charged and credit is flowed seamlessly right from telecom companies to the final customer. Last but not the least, point number 5, import of services from related establishments located outside India. If a company has any related establishment outside India and imports services from that offshore unit free of cost, then it would fall within the purview of section 71C. Classic example of such transactions are BPOs. A company with its head office in Geneva might offer some management services or consultancy services or any kind of financial services to its branch office located in Delhi, and these services could be free of cost. So these services would be taxable in the hands of the branch office located in Delhi as a taxable supply without consideration, and accordingly valuation rules will apply and GST will be attracted. That's all for today. If you found this video informative, please don't forget to hit like, share and subscribe, and please drop a comment. Thank you.